Okay, hello guys. So welcome back. Today we will talk about what is liquidity. Some of you might be knowing, some of you might not be knowing. So let me just explain what is liquidity in simple terms. Okay, so liquidity basically means that it is an liquidity it is an area, say suppose here. So where there is availability of money, okay? Availability of money in the market, like this the stop loss or the pending orders, and then buyers or sellers. Okay, so this area is the liquidity level, okay, where there is availability of money, like the stop loss of the traders, or where there is buyers or sellers. Okay, so that's about the liquidity. So okay, let me just okay, so in the last video that I have shared, that if there is a gap, there is liquidity. So for suppose here, there is a fair value gap here. Okay, let me just give you an example. There is a gap here. Here we have the gap. Okay, okay, let me just put it into the transparency. Okay, so this is the gap here. So if the market come and mitigate this gap, okay, suppose it has mitigated this gap. So how the fair value gap has become a liquidity level, let me just explain. So the after mitigation of the gap, the lowest point, this is the lowest point, where there is mitigation will become our liquidity level. Okay, that will become our liquidity. So if you see any gap, then just know that there is liquidity. Okay, if there is fair value gap, there is liquidity. So this will be there will be the liquidity here. There will be liquidity at this point. Okay, so if the market come to this liquidity level and then grab the liquidity, the market is likely to reverse from this level as well. Okay, so fair value gap means liquidity. Just know that if there is FVG or gap, there is liquidity. Okay, there is liquidity. Okay, so similarly, it's just same in an uptrend or in a downtrend. Where there is gap, there is liquidity. After the mitigation, you can take the lowest point as the liquidity level. Okay, okay, and then also support and resistance. Support and resistance are liquidity creators. They are not liquidity level. Okay, SNR. Support and resistance, they are the liquidity creators. Okay, they are liquidity creators. They are liquidity creators. Okay, so let me just explain how the support and resistance they create the liquidity. Okay, so for suppose here we have the resistance level. Okay, this is the resistance. Let me just draw I can do. Okay. Okay, so this is the resistance area. So after some time, the market moved to this level, got rejection. Okay, so the market was, so liquidity is also quantity. Okay, so the market is moving like this. It came to this resistance, to this resistance area, to this resistance. So the price action traders, after getting this rejection, from the resistance, they will put their stop loss around at this level, and their take profit will be at this level. Okay, so it is trading the liquidity. So the liquidity is here, their stop loss is here, so the market will try to hunt this liquidity. Okay, and then also some traders, suppose here we have an engulfing pattern. Okay, so this is the engulfing pattern. So after creating the engulfing pattern, what the traders they usually do is that the price action traders, so here we have the engulfing pattern, so this is the confirmation for them. So their stop loss will be around here again, and their take profit will be below. Okay, so it's creating more liquidity. Some traders after the rejection from the resistance, some traders after the engulfing pattern. So both the traders, their stop losses is here, their take profit is in this area. So it's creating more liquidity, more quantity. Okay, so what the market will do here, is that this is the liquidity. So the market will, what the market will do is that the market will go and hunt all these stop losses, and then after that the market will reverse. Okay, so this is how liquidity, this support or resistance, created a liquidity. Okay, so that's how liquidity is created in the market. Okay, so this same concept also applies to the support area as well. Okay, so let me just erase this, and then I will give you another example of how liquidity, of the liquidity level. Okay, so now you understand, right? Below this support, there will be liquidity. At this area. Okay, so below support there will be liquidity here, and then above the resistance, here, there will be liquidity. So this is the support. Below support there will be liquidity. Here, and above the resistance there will be liquidity. Here. So the market will try to hunt all this liquidity, and then it will move. So the market moves from one liquidity level to another liquidity. Okay, so trend line is also liquidity. Okay, let me explain. Okay, so here, this is the trend line, for suppose, in the market. First point, second point, and then the third point. So what the traders will do is that after from the third point, they try to take trade from this level. So their stop losses will be around here. Okay, their stop losses will be here. So what the market will do? So this is the higher high. This is the inducement. This is the inducement level. So there will be liquidity at this here, at this area. There will be liquidity here. So what the market will do is that the market will come down to this inducement area to grab the liquidity, and then the market will move. So after hunting all these stop losses, the market will move. Okay, so that's how the trend line liquidity is traded, and the market on the liquidity of the traders. Okay, so that's basically about the trend line liquidity. Okay, okay, so on. Okay, so and then order block is also liquidity. Order block. You know order block. Okay, let me just write it down here. OB. Order block is also liquidity. Okay, so this is the order block here. So in this order block, there will be pending orders. Pending order. Okay, there will be pending orders here. So the market, after grabbing the liquidity from this order block, there is the probability of the market reversing. Okay, so order block is also the liquidity level. Okay, and then break of structure. Break of structure is also the liquidity level. Break of structure. Okay, so the market was moving like this. Inducement mitigation. Okay, break of higher high, inducement, break of structure. So break of structure confirmed means we don't take trade to the upper direction or to the lower direction. Okay, because after this break of structure has happened, the market can move up or the market can also move down. So we are not sure about here, so we don't directly take trade whenever there is the break of structure, because there will be liquidity. After grabbing some liquidity, the market can also move down to this inducement level again, and after mitigating the inducement or any liquidity level here, if there's a gap after mitigation, that the market can move up again. Or after this break of structure also, without mitigating the inducement, the market can directly move up. So don't take trade right after the break of structure has happened. Okay, because that is also the liquidity. Okay, so you have to understand that one. And then also swing high and lows are also liquidity. Okay, let me just explain. So swing high and lows are also liquidity level. Okay, so let me just give you an example. Okay, to be more realistic, let's give the week. Okay, okay, so swing high and low are also liquidity level. There is also liquidity at the swing high and low. So there will be liquidity at this area. There will be also liquidity at this level. Liquidity will present here. Liquidity will also present here. So in order to confirm the swing high, we need minimum to confirm this swing high and low. We need minimum 3 same color candle. We need here. We need minimum 3 same color candle in order to have a valid swing high and low. This is the swing high, this is the swing low. Okay, so even similarly in the downtrend, there should be 3 bearish candle in order to confirm the swing high and swing low. Okay, so you have to understand that one. And then suppose, okay, so here, let me just give you an example of like this. Okay, so the market was moving in a downtrend. Okay, this is the pullback, and then here, if we have a gap here, this is the gap, whatever gap, fair value gap. So if there is a gap, FVG, if there is a gap here in this swing, so the market after moving to this gap, so there is a chance that this gap will hold the market, and then the market can reverse from this gap. Okay, but however, there is no gap. There is no gap in this whole price. There is no gap in this whole swing. If there is no gap, then the market will easily move down to this swing, to this low. Okay. Okay. So you need to understand about that, the swing high and low. Okay. And then also equal high and equal lows are also liquidity. Or there is also liquidity. Okay. Okay. So I think I have explained this one in the last video, but let me just explain it again. Okay, wait. Can delete this one. Erase this one. Equal highs and equal low. Okay, so equal low. This is equal low, right? It has the same low. See here. This is the equal low. Equal low. Okay, so equal low can be, it can be one candle can be here, then another candle can be here. Okay, it doesn't necessarily mean that it has to be like very close to each other. No, it can be like here as well. Yeah. So here we have the equal low. So after, do not take trade directly when there is equal low, because whatever can happen in this equal low. So the market can grab this liquidity here, equal low, and then it can also move up. It can grab here and it can move up again. So whatever can happen in this kind of situation. Okay, so it's advisable not to take trade directly on this equal high and low, because there is also liquidity here. So after grading this liquidity, the market can also move up or the market can also move down. So whatever can happen in this kind of situation, because there is liquidity. Okay, so equal high and low are also liquidity. So if you are trading on binary, this is the liquidity level. So if the market sweat, then we call this as liquidity sweat, right? Liquidity is here, so the wick has swept the liquidity, so we consider this as liquidity sweat. But however, in 1 minute, if you are trading on 1 minute, even if the body break out this liquidity level, so we can consider this also as the liquidity sweat. Okay, only in 1 minute, and then all only in the liquidity level, only at the liquidity level. You can consider this body breakout also as the liquidity swap. Okay, so that's about the liquidity. And then also we also have candle highs and low as the liquidity. So we have talked in the first video that there will be liquidity at the candle high and candle low. Okay, so this is the highest point of this candle, so this will be the high liquidity, and this will be the low liquidity. Even for the bullish candle, at the highest point, this will be the high liquidity, low liquidity, high liquidity, so will be the low liquidity. So in every candle there is the liquidity. Okay, at the highest point and the lowest point there will be liquidity. Okay, so that's about the liquidity from the candle. Okay, and then change of character level is also liquidity. Okay, so for suppose we have here, this is the change of character chop, this is the chop. Okay, so after having the change of character, if it just sweat, then the market move, then this will be the change of character, like we have explained in the market structure video. So if you haven't watched that, please go and watch, because I have explained about the fake change of character and then what is a real change of character. Okay, so this will be the change of character. So here we have the liquidity sweep. So in order to have a good change of character, the market must have mitigated the inducement and then give a break of structure. And also, if there is any gap and then the market mitigate the gap and then given us a breakout, then we can consider this as a good change of character. If not, if the market just sweat like this and then it's just moving up, then this will be just a liquidity sweat, liquidity grab, and then it can also directly move up. Okay, so that's all liquidity. We find the liquidity in the market. Okay, and then inducement level will be the liquidity. Okay, so let me just explain this inducement. The inducement right here, is this a strong inducement or a weak inducement? Okay, so here, if you look at here, we have the higher high here, we have the inducement here. This inducement has been swept only one time. This is the inducement, this is the swing low. It has been swept only one time, so this is a weak inducement. Weak inducement. Okay, weak inducement. So the market can just move up to this level and then it can also move down again. Okay, because this is the weak inducement. Okay, and then so also, okay, let me just give you another example here. The market was moving like this. Okay, and then this is the inducement level. So if the market did not come and mitigate this inducement level, then only after grabbing this swing liquidity, then the market will only move to this internal target, okay, if it did not sweep this external liquidity. Okay, so what is external and internal liquidity? So if the market mitigate the external liquidity, the swap the external liquidity, then the market will move to the next external level. Okay, so if the market this is the inducement is external, right? External. So if the market come and mitigate this external, then it will move, can also move up to this break of structure. This is the external, right? You can move up to this external because it has grabbed the external liquidity, right? So here, for example, say suppose you have a car or something, and then you put petrol for 500 rupees, then it will travel till around, say for suppose 10 kilometer. But then if you put petrol for around 2000 rupees, $2000 or p whatever, or euro whatever, so if you put for 2000, then you can travel till what, 20 kilometer, 20 kilometer, right? So same as liquidity. If the market grab the external liquidity, it will move up till the external level. But then if it only grab the internal liquidity, then it will only move up to the internal level. Okay, so I hope you understand. Let me just explain again. So here, this is the external, this is the internal level. If the market grab this external liquidity, then it will move up to this till break of structure, till this break of structure level. But then if the market was just come and swept this this swing low liquidity, it did not mitigate this inducement, okay, then it will only move up to this internal level, okay, and then it can also move down again. Okay, so that's how the liquidity works. It moves from, the market moves from liquidity to liquidity. Okay, so we are talking about here, this is the weak inducement because it has swept only one time, okay, it has swept only one time. And then here, if you look at, okay, sorry, if you look at this inducement, if you look at this inducement, here we have this swing here, we have the swing here, this is the swing low. So this has been swept one time, it has swept this swing low, right? This swept one time, and then this has been swept two times. So this is strong IDM. This is the strong inducement. So the market will can move up to our break of structure. Okay. So this is the strong inducement. So I hope you understand the weak inducement and strong inducement now. Okay, so also okay. Okay, something like this. This is the inducement here. We have the higher high here, inducement mitigation. This is the break of structure level, right? So here, if suppose there is a gap here, we have any gap here, F V G, or if you have any other block in this area, and then the market come and mitigate this fair value gap IDM, this fair value gap. So we have talked that fair value gap is the liquidity, order block is the liquidity, right? So if the market come and mitigate all this order block and fair value gap, then this IDM, this inducement is a strong inducement. So it has grabbed the liquidity liquidity, so the market will move up to our breakout structure. So this external liquidity has been grabbed, swept, so it will move up to external. Okay, so here 2000 petrol moving to 20 kilometer. Okay, so I hope you understand this one. And yeah, okay, so that's about the liquidity, how the where you will find the liquidity. So the market is moving like this. So we have the inducement here. Okay, IDM inducement here. So for suppose this is the support, this is the support. Okay, so after the market reaching to this support, and then if any candle give reaction from this support level, some traders they will try to place their trade here, or if they get a new confirmation from this support level, they will try to take trade here, and their stop losses will be below at this support level. So what the market will do is that what the market will do is the market will come and grab all this liquidity, their stop loss, and their stop loss. Okay, and then after reaching the inducement, what the SMC traders will do, after reaching the inducement, the SMC traders they will try to buy here, and their stop losses will be here. Okay, so the market will move up, and then here support, after the breakout became a resistance. So some price action traders, okay, the market now it has support has become our resistance, we will try to sell here, their stop losses will be here. And then what the market will do, stop losses will be here, so the market will go down and then hunt all these stop loss for the SMC traders, and then it could move up and then hunt this liquidity here, again stop losses for the price action traders. So that's how the market will trap both the price action traders and then the smart money traders. Okay, and then after that the market will move down on all the liquidity, so the market is looking like a downtrend now. So what the SMC traders think is, okay, in this member breakout is creating a lower low. Oh, the market might be liquid, the market might be moving to the downward direction here, and then the trend line here indicating the downward direction. But then what the market will do, after grabbing all these stop losses for both the price action and SMC traders, it is looking like a downtrend here. But then after grabbing the liquidity, what the market will do is the market will move up. Okay, so that's how the liquidity is created, and the market try to trap the retail traders. So this is it about the liquidity. This is the inducement. This is the inducement. Inducement mitigation means we get break of structure. This is the break of structure, so the market is moving up, right? Okay, so this is the first pullback. This will be the, we have a gap here. We have the fair value gap here. We have the order block here. This is the order block. Okay, so let's see. So we have just talked that there's liquidity here, right? Okay, so this order block has been swept for one time here, right? So This is the liquidity level. This is the liquidity. So here it has been swept again. One time swap, two time swap. Okay, let's see. Okay, and then here this is the level. See, it has, okay, wait. Liquidity. So here you see one time swap, two time swap, three time swap, and after three times swap, let's see how the market is reacting. See, it is moving aggressively to the downward direction after driving all the liquidity swap. The market is moving aggressively to the downward direction. So the market moved from one liquidity level to another liquidity level. So if it has, it has swapped the external liquidity here. External liquidity 2000 petrol. Okay. So let's see till where the market is moving. So this is the breakout structure, right? So this is the external. This is the breakout structure is the external point. This is the external point. So see, after the market, after trading this, the external liquidity, the market is moving to the external target. The market is moving to the external target. Okay, so this is how liquidity works, and I hope you understand something about the liquidity. Okay. Okay, I think this will be it for today. And then if you want to know more, please consider following, and then I will be bringing up more videos in the future. So thank you for watching.